The incredible investors inside our community have analyzed over 4,650 stocks this year. And we're going to analyze the top 5 of the most analyzed of the last 30 days from our community members. Stock number 1, AMD. Now, AMD is strategically positioned to dominate the rapidly expanding AI chip market, projected to reach $400 billion by 2027. Under the leadership of CEO Lisa Su, AMD is leveraging this transformative opportunity to redefine high-performance computing. The company is working on an acquisition of ZT Systems, which will further enhance its ability to have a stronghold on the data center infrastructure. Now, the reason this is good for AMD, it's a good complement for their current leader in CPUs and GPUs, enabling it to deliver more comprehensive and innovative solutions. Now, in addition to this, they're going to continue pushing the boundaries for high-performance computing. They need to drive more innovation across AI, gaming, and cloud platforms. These are the major growth areas for AI. So they're not only combining their technological excellence, but they're also bringing in the strategic growth. And this is helping cement them as a cornerstone for modern computing revolution. Now, let's go look at AMD to see how the company looks from a high-level perspective and to see if there's any opportunity here to buy. Now, guys, all-time high was back in March of 227, hit a low in August of 121. That's a fall of like 45% in a matter of 5 months. That's a big fall. Things can change very quickly. It's currently at 126, nearing those August lows. It's a $206 billion market cap business with an enterprise value of $215 billion. This difference here is essentially their debt of $9 billion. But look what they do right here. Their 5-year average free cash flow is $2 billion. Now, what's interesting is last year's free cash flow is down to $1.5 billion. So they actually generated less free cash flow in the last 12 months than their average over the last 5 years. And this 5-year average is before the AI boom started. So let's go check out their cash flow statement. That's an important one for me to understand. So we look here. Okay, look at this inconsistency here. Negative 130 million, 276 million, 777 million, 3.2 billion, 3.1 billion, 1.12 billion for last year. And for the last 12 months, 1.56 billion. So still half off its highs, but still significantly higher than its history. For a long time, this company was operating at negative cash flow. So let's go see what the 8 pillars look like. Now remember, the 8 pillars are here to tell us a story. 4 checks, 4 X's. We've got revenue growth. We've got net income growth. We've got free cash flow growth. And they're pretty consistent across the board in terms of net income and free cash flow. But guys, 5-year price to free cash flow of 100, 5-year PE ratio of 112, shares outstanding. Guys, this is what makes me vomit all over the place. This is me. Is that my face, my nose? That's me vomiting all over. All over. Why? They're diluting their investors. I hate this. I get it. I get why they do it. The stock's expensive. That's the company's way of saying our stock is expensive. Let's go give shares out to the people who are obsessed with it. Great. But at the end of the day, I look at this company versus NVIDIA. NVIDIA has a much longer and better track record, if you ask me. Look at the gross profit here, 48%. NVIDIA is at 75 to 80% gross margin. They make almost double for every single dollar they bring in versus AMD. Look at this bottom line profit. 7.5% and 10%. Listen, this could be the early stages of a major turnaround for AMD. This company's gone up and down. I mean, you go look at the chart here. Look at this chart. Look at the stock chart. It got as low as $1.94 back in 2015. That means if you bought it that low in 2016, you'd be up over 60 times your money. That's insane. But they've struggled to make money. And look at this. What's also amazing. Their all-time high in 2000 was $48.50 or so. They didn't hit that price again until December of 2019, 19 years later. It just goes to show it can be scary out there. So the question is, what's the stock worth? This is exactly why we have the stock analyzer tool. Our goal of the stock analyzer tool is every investment is the present value of all future cash flows. But we don't know those cash flows. That's why we make low, middle, and high assumptions on revenue growth, profit margin, free cash flow margin, the multiples of earnings and free cash flow, and our desired return. It gives us a range of what to look at. This is very important when you're sitting there looking at a company. You got to merge the numbers with the story. These numbers are going to be dictated by the story. What kind of growth does this company have? Let's actually go check out analyst estimates to see what they think. EPS growth, wow, tripling. So this could be a turnaround for AMD. This could be the start of their domination. And revenue growth, look at this revenue growth. 26 billion to 50 billion, almost doubling in the next 4 years. That's incredible. So again, let's go back to Stock Analyzer. I did a 10-year analysis here. I did 8, 12, and 16% revenue growth. I did 8, 15, and 22% profit margin and free cash flow margin. Keep in mind, guys, my middle metric here has never been achieved in the last 10 years. That's something to keep in mind here, guys. I want you to remember that. I'm giving them more credit than what they've done. I'm assuming their scale is going to make them better. PE, I did 18, 21, and 24 because I think to myself, this is going to be an AI leader. They should get a premium to the market. And my desired return, here's the one area where you have to deviate from. I put in 9% because the market average is 9 or 10%. So I'm trying to sit there and say, what's this thing worth intrinsically? What's its natural market return? But remember, if you're going to buy an individual stock, you need to put a margin of safety. Because if you're not going to, just buy the market. You'll make 9 or 10%. In addition, you could very well be wrong. You need that margin of safety. But for right now, I'm going to hit the Analyze button. Here are my prices. I got a low of 30, a high of 186, a middle price of 85. So even my middle assumptions, which were profit margins higher than they've had, it's still a hard pill to swallow. Now, you might disagree with my revenue growth, etc. But remember, I did a 10-year analysis, not a 5-year analysis. And you modify these numbers, you'll come up with your own set. And that's why it's important for you to be able to put your numbers in. And it's also why our users in our community use this tool over 1 million times per year. Stock number 2, Ulta Beauty, a stock that I own. Remember, guys, don't ever buy a stock because anybody in this world, especially someone on YouTube, owns the stock. Now, you could argue that Ulta Beauty is the ultimate powerhouse in the beauty retail industry. They have 1,437 stores across all 50 US states. They have an amazing e-commerce platform, which has allowed the company to masterfully expand its physical and digital presence, solidifying it as the largest specialty beauty retailer in the US. This physical and online presence ensures that Ulta is never far from its millions of loyal customers. So inside these stores and online, they have over 25,000 products from 500 brands. Whether shoppers are hunting for budget-friendly drugstore essentials or splurging on higher-end luxury products, Ulta offers something for everyone. And at the heart of all this success is its widely popular Ultimate Rewards program, boasting a staggering 41 million members. These fiercely loyal shoppers account for an incredible 95% of the company's sales, underscoring the unmatched customer retention and engagement that sets Ulta apart. Now, guys, I've had Ulta. I like the numbers, and Warren Buffett bought Ulta, well, Berkshire Hathaway did, and then they sold it, and then it skyrocketed on earnings, etc. But let's take a look at this. For one thing I love about the company, $20 billion market cap, $23 billion enterprise value. That's a $3.4 billion essential net debt. And look, they generated $1 billion in free cash flow in the last 12 months. That's incredible. Now, their free cash flow is slightly lower than their net income, so it's kind of an issue. But I look at this and hopefully it's within reason because they're growing stores, remodeling stores, etc. Look at this, guys. Gross profit margin of 39%. It's almost freaking at AMD. And that's incredible to me. Bottom line profit, very consistent, 10 to 10.5% over the last 5 years. Also beating AMD currently. That's incredible. But even more impressive, guys, is the return on invested capital. 21% over the last 5 years, 27% last year. They do a great job of getting a return on the money invested in the business, and that's important. Now, 8 pillars. Guys, apart from its 5-year price of free cash flow, it's all check marks here. And guys, guess what? Before their earnings release, this was all check marks. This was an 8-pillar thriller. But the thing I like a lot here, buying back shares. They're not afraid to. They're not afraid to buy back shares. I think they get the idea of buying back shares. They understand buying at lower prices, buying at lower valuations. So let's see what analysts are saying about Ulta. Earnings per share, $26 a share, going to $41.59 here in the next 5 or 6 years. And revenue growth, not the greatest, $11.4 billion to $15 billion. Mid-single digit growth. Nothing to write home about, but they're being smart about their growth, which I like. So Of course, the next question is, what's the right price to pay for Ulta? Let's pull it up the last time I did it in our stock analyzer tool. And guys, I didn't do anything glamorous. Remember, all these stock analyzer tools do not include the balance sheet. But I did 2%, 4%, and 6% revenue growth. I did 9.5%, 10.25%, 11% profit margin and free cash flow margin. I did a PE of 15, 18, and 21. Even though there's an increasing ROIC and a high one, it's still retail. So I'm okay with 15, 18, and 21. To me, it's not a 15 PE, and it's also not a 25 PE. Somewhere in the middle. And finally, my 9% desired return. Hit the analyze button. Boom. I got a low price of $327, high price of $630, middle price of $455. At current prices, if you bought today, you're looking at about a 10% free cash flow IRR. Stock number 3, Uber. Guys, Uber has done a great job of going from a company that's going to spend whatever it takes to grow to being a cash flowing business. It's still continuing to race ahead, forecasting a remarkable 20% year-over-year increase in gross bookings with robust revenue growth across its mobile and delivery segments. Guys, I don't know if you saw the show on Netflix about Uber, but this has been confirmed. They said the second somebody uses Uber twice, they're hooked on it for life. That's incredible stickiness. One of its latest game-changing moves is a new collab with Instacart, integrating its extensive logistics and delivery network with Instacart's platform to reach suburban customers. Guys, I am lazy and I've got money, so I order an Instacart all the time and I pay whatever absurd fee they give me because I love getting things delivered to me so I don't have to go out and go do it myself. At the same time, Uber is revolutionizing the future of transportation through investments in autonomous vehicle partnerships. In Japan, the company debuted its first international fleet of autonomous delivery robots for Uber Eats, a bold step in the future of tech-driven logistics. Now, that story is wonderful, but the numbers tell an even better and more compelling story. Uber facilitated, ready for this, 2.6 billion trips in the first quarter alone. That is a 21% year-over-year surge. With a commanding 76% share of the US rideshare market and 25% globally, it solidifies its position as the world's top mobility platform. But Uber isn't just about the rides. The company is unlocking innovative revenue streams through initiatives like in-car video ads and strategic partnerships while enhancing its platform with cutting-edge technology. Its delivery business is thriving, achieving an 18% year-over-year boost in bookings. Now, these milestones reflect Uber's relentless drive to redefine mobility and delivery. So let's check out Uber here. Now, like I said, guys, look at this free cash flow. 5-year average free cash flow, $570 million. Last year's free cash flow, $6 billion. Talk about a focus on cash flow. Incredible. Their 5-year return on invested capital, negative. Last year was positive. Good sign there. Net income, look at this. Free cash flow, $6 billion, net income 4.4. So I love that. Guys, all around, there's a lot of good news happening here. Gross profit of 40%. Okay. Not as great as I thought, not as bad as I think. I mean, it's software, but they got to share money with the drivers. But guys, imagine a world in which there's no drivers. Imagine that. What's going to happen with the split? It's going to be a lot more cost effective. All right. So my guess is the pillars look crappy here. Yeah, 5 X's, 3 checks. Revenue growth, net income growth, and cash flow growth are much bigger. Look at this. $6 billion in free cash flow last year, which is a $10.4 billion increase, which means they were doing a negative $4.4 billion in free cash flow just 5 years ago. Shares outstanding, up a lot. I hope this starts to stop that share outstanding increase. We can go check and see how they've done on those increasing shares in the last few quarters by going to the income statement, going down to the bottom. All right. So if you look right here, this is quarterly, not yearly. So slight increases over time from 1.96 billion in June of 2022 to 2.1 billion. So still a 5% increase. All right. Not the worst, not the best. Got it. So let's see what analysts are saying. Okay. $1.81 this year in profit, going to $5.50 in 3 years. Huge growth on their profit. And guys, this is what happens. When companies start to focus on profit and cash flow, it can be a massive growth like this. Well, not inverting back, but you get what I mean. Because I'm looking at saying this company spent astronomical amounts of money just how do we get ingrained? And guess what? They did it. And then the revenue growth, pretty solid, $44.5 billion to $73.5 billion. I look at Uber going, this company's going to be around for a long time. It's going to make a lot more money. The question is, can you justify the price today? It's clear this company's a leader. It's clear this company is doing well. So let's go check out our stock analyzer tool. Have I done Uber in the past? Let us see. I have, actually pretty recently. 10-year analysis. I did 6, 10, and 14% revenue growth. For profit margin, I did 8, 14, and 20. Might be low. I could see, I'm going to go higher on this one. I'm going to go 8, 16, and 24. I don't think 24 is attainable because they do 40% in gross margins. That'd be very little. That's probably pretty high. Actually, maybe it should be 10, 15, and 20. And guys, you don't have to put equal spaces between these. I just do. Now for a PE, this is a market leader. I did 15, 18, and 21. They're currently at 30 times earnings and 21 times free cash flow. And the 9% no margin of safety return. So hit the analyze button. Now, guys, it's really important that you understand why we make these assumptions the way we make them. It's so important that people see the stock analyzer tool. It's been used over 1 million times in the last year alone by our users. Guys, we have some stocks in here that have been analyzed over 10,000 times in the last year. Now, that's not it for the software. We have all of these tools here: retirement calculator, 8-pillar search, analyst estimates, even a real estate calculator, and we're pulling in economic data from the St. Louis Fred website. Guys, this software right now includes everything up there. But behind the scenes, we're making changes. And the reason is, guys, we got to make the software better. As time goes on, this software needs to adapt to what the needs are for the users. Because when I built the software, it was only built for me. I did not think it was going to become something for everybody. I had the software, I was making videos, I was writing down, and people were like, hey, how do I get that software? And I'm like, yeah, you can't get it. It's a data feed, it's expensive, you can't get it. And finally, I said, wait a second, we can make this for people. Enough people are asking about it. But as I go on, I have to make better versions of the software to adapt to what I need. Real estate calculator was just added in the last couple of years. Why? Because I make a lot of real estate investments. I've bought over $35 million in real estate alone this year using that real estate calculator. I just had a friend of mine. He went into contract in a building here in Ohio, and he said, dude, your real estate investment calculator was phenomenal. But as we grow more and more, it has to become less about me and more about how I can better serve you and other community members. And this is why we update our software continuously. We have many developers working on the software every single day. The good news is these changes take time. We want them to be done well. So you have time to be grandfathered in for life to get all of these by signing up today. I'm telling you this because there's still time to sign up. Go join. I'm not asking for a long commitment. I'm asking you to make an informed decision. $7 for 7 days. For $1 a day, you can try everything out before we make the changes. The best news is you sign up, you get these for life, and you stay in your pricing tier forever. So click on that link to get access to everything we have to offer, and I guarantee you it'll be the best investing decision you've made all year. So we hit the analyze button here. The stock's currently at $60 per share. We have a low of 37, high of 172, middle price of 85. Guys, this is an interesting company. If you buy at today's price, the middle assumptions occur and they don't dilute further. 13.7% return. But you got to remember, if they keep diluting, that eats away at your ownership and that eats away at your return. Stock number 4, Target, another company that I own, got hit hard recently. But guys, I believe they're set to achieve massive growth in 2025, fueled by its powerhouse of exclusive brands like Cat & Jack, Threshold, and Good & Gather. Target's customer base is growing exponentially with more than 100 million members in its Target Circle loyalty program in 2024. Now, beyond this brand expansion, Target is heavily investing in physical and digital growth, with plans to upgrade hundreds of stores over the next decade and enhance its e-commerce capabilities. They've also partnered with Ulta to be able to put Ultas into stores, which I think it's going to be a big benefit because women love Ulta and women love Target. These efforts are designed to meet the demands of an even broader customer base, positioning Target for long-term success. So This is a company that's down significantly from its all-time high back in 2021. About 3 years ago, they were at $248 a share, and now they're at $131 per share. They have a dividend yield of 3.38%, which eats up $2 billion of its $4.5 billion last year and $4 billion 5-year average free cash flow. So they can afford this dividend. It eats up less than half of last year's free cash flow. Current PE of 13.8, current price of free cash flow of 13.3, low double digits. So the question is, if this company can maintain growth, how does this not work out? So let's go check out the 8 pillars. So guys, we have 2 X's. Long-term liabilities, which include leases, don't care. Cash flow declined. I don't like that. But guess what? Even with a decline of $2.8 billion, it's still higher free cash flow than their 5-year average. So that doesn't worry me so much from a high level. So I'm looking at this saying, is this essentially an 8-pillar thriller? Could very well be. What are analysts saying? Well, they have EPS growth. Nothing sexy. But look, 5%, 8%, 8%, 16, 9%. All right. High single-digit growth and revenue growth overall, low single-digit. 0, drop of 1%, 3, 3.5, 6.74. Now, guys, I want you to remember, people were always worried about the shrinkage, how much theft was having at Target. Not happening anymore. It's been decreased immensely. They went back to same-store sales growth this last quarter from a drop of 6 or 7% the previous quarter. So the question becomes, what's the right price for Target? 2, 3.5, 5% revenue growth. This is going to be difficult, but if we have continued inflation and they continue to grow steadily in new locations, that's achievable. Profit margin, 375, 425, 475. Same with free cash flow. PE and price of free cash flow, 15, 18, and 21. Pretty good ROICs, but nothing to write home about. But it deserves a premium because I think Target is a company that's going to be around for a while. And I think it's a go-to for a lot of women. And my 9% return, hit the analyze button. The stock's currently at 131. Boom. Low price of 125, high price of 240, middle price of 175. 13% return based on today's, if you bought at today's price. And that includes the dividend. So don't add the dividend on top of that. It's a discounted cash flow return right here. So if my middle assumptions are correct and they keep trudging along based on today's price, you can expect a pretty good return. I started buying this thing at 135 all the way down to 105. It went to 100, then shot up to 180, then down to 120, and now back up to 131. That is the volatility of this company over the last 2 years. Don't set your right or wrong based on this volatility. Principle-driven investing, we focus on the fundamentals of the business and paying a good price based on those fundamentals because every investment is the present value of all future cash flows. Stock number 5, Nike, another company that I own. Nike is absolutely dominant in the global athletic wear and footwear market, making it one of the most exciting investment opportunities around, especially because all-time high was 180 and a 52-week low back in August of $71 per share, and it's currently at $78 per share. Who would have thought a company like this would fall by over half? In fact, in the past when we made videos, people thought that was unreasonable. But the company revolutionized its brand through game-changing partnerships with legends like Michael Jordan, LeBron James, Serena Williams, who've all played a pivotal role in boosting recognition and loyalty. The ongoing success of Michael Jordan's Nike collaboration, especially with the Air Jordan line, has been a massive driver of the brand's power. In fact, guys, of their $50 billion in revenue, about $7 billion comes from Jordan brand. And by the way, Michael Jordan gets 5% of that. He makes between $300 and $350 million right now with Nike. Incredible. This guy is printing money. Nike's market share underscores its leadership, with the company commanding 27% of the global athletic footwear market. It also leads the charge in North America, comfortably outpacing its competitors like Adidas and Puma. Just like the other companies, their loyalty is incredible, with 100 million members in its Nike membership program. The brand builds strong connections, gathers invaluable data that drives personalized experience, and then leads to more sales. In addition to that, they're doing more direct-to-consumer, which is going to drive the bottom line, because now they don't have to sell to a retailer and only mark up and only lose half that revenue. They can now do it directly. Now, globally, Nike is continuing to grow its presence in key markets like China and Europe while maintaining that stronghold in the US. So let's check out Nike here. $118 billion market cap with a $130 to $140 billion enterprise value. Guys, $4.7 billion in the last 5 years, average free cash flow. Last year's free cash flow, the last 12 months, $7.2 billion. You know what I heard from people after they said saw Nike stock fall? They said, Paul, Nike is dead. How the hell do we say Nike is dead? How do you say Nike is dead? But people out there believe it. Return on invested capital, 18.7% in the last 5 years, 20.4% last year. This company has 45% gross margin. That's equivalent to Apple. This is an incredible business with very consistent profit margin, as you can see. Now, one thing I will say, their 5-year free cash flow is slightly lower than their 5-year net income, but they had a big jump in free cash flow relative to income last year. All right, let's go check out these 8 pillars. This is one of the ones we like to see. Everything's a check except for valuation, and these valuations aren't far off. And I would argue these guys deserve a premium. These guys deserve to have a premium paid for them. It's Nike. It's probably not going away. Again, I ask the question, do you think Nike will be around for 10 to 20, 30, 40, 50 years? Of course, people probably said the same thing 40 years ago with a lot of other companies. This company is leading the pack, and they dominate. They're synonymous with trends, with quality, with athleticism. It's hard to lose that, especially when you sign the 2 biggest basketball players of all time to a lifetime contract. So let's see what the analysts are saying here now. $377 per share in profit to $636 over the next 4 or 5 years. All right, almost doubling. And revenue growth, a little inconsistent, but $52 billion to $67 billion. So what is that? Mid-high single digits? Call it mid-single digits. Not a lot of growth there, but a company like Nike, slow and steady growth with a good gross margin and increasing that gross margin can really add to the bottom line very quickly. If they can make their gross margin from 45 to 50%, that would be huge. And they could make their bottom line profit from 10% to 12 or 13%. It's a 30% increase in their net margin. That would be astronomical. But you'll see in our stock analyzer that I don't even factor that in there. Let's look up Nike when I did it in the past. These are my Nike assumptions in the past. 3, 5, 7% revenue growth. Profit margin, 10, 11, 12, and same with free cash flow. I gave a slight bump for the fact that they're doing more direct to consumer. I put in the highest PE in this video on Nike, 20, 23, and 26. I do believe it deserves that premium. I could be wrong, but I do believe that. And my 9% desired return, the stock's currently at $78 a share. Hit the analyze button. We have a low price of 60, high price of 119, middle price of 85. Not a huge number here, 10%, but enough where I go, it's worth it for Nike. Guys, if you want to see the top 5 stocks that I own in my portfolio, watch this next video. Thank you for your time.